Private real estate returns in the fourth quarter of 2024, the lead-lag relationship with listed REITs, and the shifting performance of private market property types. This month, we are digging into the performance of the NCREIF ODCE Index. Many institutional investors are benchmarked to this private CRE index, making it an important market barometer. Welcome to the Real Estate Reel from Cohen & Steers. First, the NCREIF ODCE Index posted positive net total returns of nearly 1% in the fourth quarter of 2024. As a quick review, ODCE stands for Open-End Diversified Core Equity. The index tracks 25 private open-ended core funds representing over $200 billion of commercial real estate assets. This is the second consecutive quarter of positive total returns following the 2 basis point increase last quarter. Net total returns were negative for 7 straight quarters between the fourth quarter of 2022 and the second quarter of 2024. Importantly, appreciation returns were also positive in the fourth quarter of 2024 for the first time since the second quarter of 2022. This underscores our view that private CRE valuations have likely troughed. Indeed, an analysis of historical total returns post the S&L crisis in the early 1990s and post the Great Financial Crisis shows that when total returns turn positive, they remain positive. The second point I'm watching is the relative performance between private CRE and listed REITs over the short, medium, and long term. While ODCE returns rose in the fourth quarter, listed REITs declined by more than 8 percentage points. This may seem like a significant difference at first glance, but there have been other quarters since the start of 2022 with greater dispersion in returns. We don't think quarterly returns tell the entire story. Listed REITs generated total returns of 5% in 2024, while ODCE was down 2% during the year. This follows a more than 20% return relative outperformance of listed REITs in 2023. By comparison, listed REITs declined 25% in 2022, while the ODCE Index rose nearly 10%. We've long argued that listed REITs are leading indicators in both downturns and recoveries, and this cycle has been no exception. Indeed, listed REITs have outperformed the ODCE Index by 40% since the third quarter of 2022. However, since the end of 2019, the price returns for listed REITs are similar to ODCE at negative 2% versus negative 5%. In other words, while the path of travel was different, the end outcome since before COVID has been similar. It's worth noting that listed REITs produce superior total returns to ODCE over the cycle. They gained 18% compared to a 9% return for ODCE since 2019. This is consistent with our analysis that listed REITs historically outperform ODCE on a total return basis over the medium to long term. Finally, we are digging into the performance of ODCE Index across property types. Open-air shopping centers, classified as strips by NCREIF, led with unlevered total returns of 1.7% versus 1.2% for industrial as well as apartments, and 0.6% for central business district office. Industrial and apartments were also positive during the quarter, but office remained in negative territory with unlevered total returns of negative 0.7% and levered total returns of negative 3.2%. This pushed full-year unlevered total returns for strips to 5.2% compared to 2.5% for industrial, 1.5% for apartments, and negative 9.4% for central business district office. This is the second year in a row where open-air shopping centers were the best performing property type, a sector that ODCE funds are underweight relative to industrial and apartments. Bottom line, we think the performance patterns of property types across private real estate are shifting. What worked last cycle, industrial and apartments, may not work as well this cycle. Subscribe to the Real Estate Reel via the link on the screen and tune in next month to see what we are watching.